But where is the market and the economy headed next? Who better than Venugopal Garre, the MD at Bernstein, joining in on the show right now? Venu, hi, good morning. Great to have you on the show. Thank you so much for taking the time out. Volatility clearly is increasing with rising yields, weakening, and just every now and then you are getting commentaries, if not from the central banks, now from the governments themselves. Just wanted to understand, Venu, where is India amidst all of this? Are we better placed, or do you think risks loom large for us as well? Because for a long time, we did manage to decouple from the global weakness.
Thanks a lot for having me on the show. This volatility, as I always mentioned, is a feature which is going to be lasting for a while. We really have to live with it. And I think the point about India decoupling was more on a market's context, was more on a relative context, I guess, where the market was looking at relative to other emerging market countries, especially from an economic standpoint. Because very clearly, domestic economy looks still okay and probably better placed compared to what we see in other countries. So that is the only positive factor that I see at this juncture. But I guess volatility, which is driven by external factors, that is where we need to see the impact on India. And some of that is driven by the rate cycle. Some of it is, of course, driven by what is happening globally. The impact of that on the economy needs to be, of course, measured. And more importantly, how current account deficit shapes up, that volatility as well, could be both positive and negative as well, is going to be remaining for the rest of the year, I guess. So what it means for the markets, I would probably say that beyond a certain stage, it is very tough to make a lot of money directionally in these markets, because this volatility will keep your upside as well restricted to that extent. And an okay economy will probably restrict your downside as well too much. So that's why it's very hard to move away from this range bound view theory that we have been holding for a year on the market.
Venu, I was going through a couple of your notes, and what you say is that India is going through a forced rate cycle. Considering we're just counting down to the MPC outcome announcement by the governor, I'm tempted to ask why so? Because India too is grappling with high inflation.
I would probably argue in a very simplistic way that by driving down demand materially, which is what you'll probably think about, that rate hikes would actually do. The usual perspective is that probably that is going to bring down at least inflation or inflationary expectations. But my broader thinking is that to a large extent, what we see as potential inflationary impacts on India is more supply-led. And I think it's across the board, supply-led issues rather than demand-side issues. So if interest rates are going to address demand-side issues, I don't think that would have been the most appropriate measure in any case. And the second thing which I argue is that the sensitivity of interest rates to bringing down demand as well, especially for rate-sensitive industries, is going to be relatively lower this time, because a lot of these rate-sensitive end markets, as we call it as, especially end markets like autos or housing, for example, are in a very different state of the cycle. So you may not even achieve those outcomes of material demand moderation if you do that. So this rate cycle increase, I guess, is like of a choice. And that is driven by the fact that you don't want to basically have a very counter-cycle view at this juncture at a global level. You want to be maintaining your rate spreads with the global rates, especially with US. Otherwise, you tend to see significant volatility in terms of what happens externally on currency and things like that. And I guess whoever has tried doing anything odd at a global level, we have seen them being punished. Be it what we saw for pound or what we saw for Japan, for example, earlier this year.
Okay, Venu, so that's about how the macros are really stacking up. But talking a bit more micro, you talked about the fact how it's very difficult to make money in this market given the range-bound moves that we are seeing at least at the index level. But how should one position their portfolio in this sense in terms of specific stocks and themes and sectors that you're looking at this point of time?
Yeah, the reason why I said it's tough to make money is even though if you're very comfortable with the range, you can range trade at the index level, saying that you probably buy at the bottom if you believe that below 16,000 is the bottom and sell at 17,500, right? That's an index level trade. That's like very difficult to, do from a fund level perspective. At a portfolio level, again, the challenge is primarily that sector rotation can be fairly violent in such phases because people want to make extra money, so keep rotating sectors. So it's very difficult for large funds to actually, sort of keep rotating sectors as well that quickly. Now, the way we have been approaching primarily is wherever we felt that relatively valuations are a bit more comfortable. And since we are still okay with the domestic cycle, where we thought that even second half of the year, while economy will slow, it is still probably going to be growing at a decent pace. We looked at sectors like financials, where we've been overweight for a while. It's been doing okay for us, but that still remains as one of the key sectors that we overweight. Outside of that, purely from a perspective of generating returns, we felt cement was a decent sector within the industrial pack. So that is something we upgraded to an overweight about a month and a half or back compared to our underweight stance last year. And some of it is also because of sort of troughing down of, or rather peaking of costs and maybe troughing of volumes as well. Energy is another sector which is downstream where we ended up, after a long time moving into an overweight because we felt valuations we were comfortable with. IT sector is not a new sort of an overweight for us, but it's more large cap led. This is where we are overweight. I mean, underweight in a lot of sectors. We moved industrials, excluding cement, to an equal weight from overweight after that sector having done really well on the stock markets. Utilities, we are underweight. It's actually also done well. We are all sort of underweightish on metals, but reduce the weight. That's probably the only change that we did. And consumption pack, we are underweight with staples, with something where we downgraded outright to an underweight from an equal weight.
Okay, what about your outlook when it comes to the entire earnings season? What is it that you're penciling in for Q2?
You know, honestly, the expectations when I look at even Nifty EPS growth rate is not that tremendous. We're looking at, I guess, high single digit EPS growth for Nifty this year, and then next year maybe mid-teens. So in that construct, I don't think expectations are high, from a numbers perspective to start with. There are certain sectors where within the overall pack expectations are high, which is more consumption side. So I guess autos, consumer discretionary ex autos, also the expectations are relatively high in terms of growth rate recovery, while most of the rest is, probably single digits to low double digits. Now, purely from a flavor perspective, I guess the theme would be more about a situation where margin story would be probably discussed more than the top line story, because I guess pace also is catching up as we head into this particular quarter. So to that extent, growth from a top down perspective, especially volumes, may not be that tremendous, but not that bad as well. But I think margin recovery is an area which is probably going to be the one to watch for from a surprises perspective.
Okay. Okay, so that's the word as far as the margin picture is concerned. But explain to us your rationale behind IT a bit more, given the global slowdown that we are seeing, as well as the supply side pressure is not completely off the table. Accenture also pointed out how the tight labor market conditions are likely to continue for this year. What makes you bullish? And you're more skewed towards large caps?
Yeah, the change that we did beginning of the year was focusing just on large caps uh, and moving away from mid caps, mid within IT. So that's a big change that we did beginning of the year. And this is different from the previous 2 year view for us, where we were overweight outright. Now, IT has underperformed massively. If you look at year to date, uh, purely from a valuations perspective, the most interesting thing is after a situation where IT sector overall ended up merging or being very similar to consumer staples in terms of valuations. Now the gap has expanded materially again. So the relative valuations between consumer and IT looks pretty okay to us. The second thing is, when I look at purely fundamentally, we are talking more about large cap resilience heading into the next 12 months. We are also in a situation where we believe services spends, especially on the IT side, may be relatively more resilient than product exports, which is where I think the inflationary impacts will be much more material at a global level. So that's one big difference. Second thing is, we do believe there's an inflexibility from a corporate's point of view to materially cut down their IT spends as well, given the nature of IT spend being very different now versus what it was probably a decade back. And on the wage side of things, the bulk of the challenges are behind. That's the more important thing. The power in the system is moving to the IT services companies in terms of their ability to be a bit more flexible with respect to managing the wage cycle. In fact, we've started seeing a lot of layoffs happening at a global level across the board in tech, and I think supply of people is going to also increase over the next 12 months, which is probably positive, even though it may not necessarily be the only reason to be in IT. So that's the reason why we ended up still holding on to IT, even though we tweaked up to just looking at some of the large caps.
Which of the sectors would you be betting on in order to that you believe will drive the festive sale momentum going forward?
Yeah, so the first point is, should we be positive on festive season at all? Because I guess consumption stocks did really well as a sort of a basket, both discretionary and staples in the last couple of months. So I think a lot of it is being priced in any case in terms of positivity heading into the festive season. The second thing is I think festive season is also going to show a very similar situation where certain categories might do well, which probably are more out of home led, but then smaller categories or small value discretionary categories like appliances might still hold up. So in that sense, maybe that is an area one where I would still be fine with in terms of looking at potential opportunities, because it's always been a costly space, so it's okay. And outside of that, I guess I think if I were to purely put it from an autos point of view, I think PVs should be okay heading to the festive season. But I think a lot of it is being priced in any case, even in the auto sector at this juncture.
Thanks much for taking time out and joining in, giving us a view on the overall markets and as well as portfolio allocation.